So last week we discussed the importance of having a purpose for your plan. This week we're going to discuss the importance of having purpose for each of those positions in your portfolio. Mindset matters. We've talked about it. We've written about it. How do you evaluate things? How do you evaluate the framework to make financial decisions in your day-to-day life? That was last week's commentary, really around the purposes to your plan. It can be a lot of things that are good, but what's best? What is most important for you is what we want to help you get at. Same types of things apply to a portfolio. A lot of people wonder again, is it working? Am I in the right things? Well, what is the purpose for that position? Certainly at a base level, people invest to make money, but there's so much more than that. We've covered that within our LIVE methodology, from the liquidity you need to income generation to supplement or replace, how much volatility you can live with, to again, then the expected return, that making money over time. And so wanted to come back to, as you sit down, particularly at a time when markets in general aren't working, to not just give up, to know when things are just having a tough time, when a position is actually doing exactly what it should do, or when actually something may be broken. The first thing we like to tell our clients when they come in, particularly those who feel intimidated or overwhelmed by trying to decide the best course of action or what they might want their portfolio to look like, is, hey, just talk to us in the following three things. First, time frames. What is the time frame for this money? Is this something that's building up for a 6, 12, 24 month type need? Or is this something that, again, is there for you 20 years from now? It's going to absolutely change what we might be invested in. What are the goals? What are you hoping to do with this money? Perhaps you need to go after certain rates of returns to be able to achieve certain goals or objectives that might be more aggressive. On the other hand, you may find out, no, we don't need to take some of those risks to achieve some of the goals that we have. And again, lastly, and it really wraps around all this, is, are we investing in such a way that emotionally, when these tough times come, you're going to be able to stick with it, give it that full time frame to reach the goals we just talked about. So let's talk with point number one, which is understanding the role of your positions. Again, beyond just that LIVE methodology we talked about, if you look at some conservative positions, AKA usually bonds, fixed income within someone's portfolio, I've had clients in the past, or people ask like, well, what is this supposed to do? Yeah, well, you hopefully get 3 to 4%, buffer volatility a little bit. And they'll be like, well, why are we holding that? This other thing is going up 20% a year. Well, it may have gone up over that a certain time frame, but we'll remind them, hey, this is something, again, this is the money for that down payment on the house that you wanted to save up. And we can't put that at risk of a huge bear market in the stock market right when you're wanting to buy a house. Or perhaps this is here to buffer volatility, to help offset the total portfolio volatility, to let you give these more aggressive things time. Then they're doing their job. They're playing their place. Their job isn't to try to perform on a long-term basis the same as a typical stock would. For stocks, that aggressive part of your portfolio, again, you're going to inevitably have periods like we're in right now where markets are tough. Those equities aren't there to necessarily buffer volatility, clearly. You have to be ready for the ride that they're going to take you on. But while you're in those positions, let's just take the broader stock market again, is to hopefully achieve some bigger goals with more time to get those higher rates of return than you would with your more conservative positions. And again, it's the marriage and the balance of those things that's so critical. As we talked about a few weeks ago with Jake, the missing piece to so many portfolios is really that third piece, those alternatives. Here again, in a lot of cases, they're not going to keep up with stocks. Some cases, maybe private equity, they could do even better. They're not necessarily to be a bond. There are lots of different types, but what they're here to do is act differently. That's their job. Their job is not to act like the S&P 500. It's not to maybe give you the income stream you might get from a bond. They're there to act differently, to, again, mitigate volatility, to have parts of your portfolio that should be working at all times, to be able to have something in case of an emergency need, so you're not a forced liquidator. That's really the role of an alternative, just to be different. When you think about diversification and putting these things all together, it's important to remember that yes, hopefully in part that means there's something working within your portfolio all the time. That's why we've been preaching get beyond just stocks and bonds, figuring that this moment that we're in right now, where both of them are struggling, was going to be upon us sooner rather than later. Thus our press for alternatives. The inverse of this, and really the patience part that I'm trying to get at with each of these positions, is if you're diversified, as the old saying goes, you know you're properly diversified when you're unhappy with some part of your portfolio all the time. When the stock market's up, you're going to look at those boring bonds or conservative parts and say, man, why do we hold this stuff? Conversely, during tough equity markets, those conservative positions are there to buffer you up. So it works both ways, but put together correctly over time is going to help you immensely. Sum it up. In terms of positions and how they act, I think of the old Chris Rock joke where he's talking about the Tiger incident years ago with Siegfried and Roy, and how he was so befuddled by people who would say, man, that tiger went crazy. And he's like, the tiger didn't go crazy. The tiger did what tigers do, which is it bit somebody. Same type of knowledge when you look at portfolios and positions. People will say, oh my gosh, the stock market's acting crazy. No, it's not. Stock markets go through volatile times. Stock markets experience corrections in bear markets. It's just doing what they do. You had to be prepared for that. So too with bonds. Hey, these things aren't keeping up. Well, they're not meant to keep up with your stock market. So when that position within your portfolio is acting like the tiger, again, don't let it surprise you. Surprises are what get you off track, and that's exactly what we want to avoid. So in summary, are your investments working? Again, know their purpose. Know their characteristics is really point number one. Number two, know the environment you're in. It's again, not that you maybe have a bad ETF or stock or mutual fund. It's just a tough time in the equity markets. Or conversely, if it's been a really great year and you're taking that risk within an ETF or fund or whatever the case may be, and it's not keeping up, you need to know that too. I see a lot of people who think, well, I got 8%. Well, if you took risk that should have given you 20, that's a problem. So again, understand the characteristics, understand the environment, understand the purpose for your plan and your portfolio, and you'll be on the way to achieving those goals. Thanks so much.